Welcome back, investors, to Ticker Time News. I'm Adam. Thank you for joining me for the After Hours show. This show is for you. So if you have a question, leave the ticker symbol and your question in the comments, and we will go over it live during the show. We have got a bunch to talk about, but it's always most important to me is what's on your mind. So please leave that question if you have one. All right. We've got Harley Davidson to talk about. Its turnaround looks like it's finally on the right path. We've got Take-Two to talk about in their earnings. So we're going to do a deep dive on both of those companies. Take-Two should shed some light on Corsair Gaming and what's going on with that stock today after it reported its earnings today. And of course, we got Peloton's earnings, ENPH earnings, and Corsair Gaming earnings all came out after the close today. That we'll highlight just real quickly. Of course, after the market recap. So if you do have a question before I get into this, just leave it in the comments and we'll go over it. If I see it, we'll stop. We'll go over your question, whatever it may be. All right. The indexes today, they all ended higher, with financials and materials both leading the way, as a solid earnings report outweighed fears about, of course, the rampant end to the pandemic era monetary policy. The Dow finished 372 points higher. The S&P gained 0.84%, while the Nasdaq added almost 1.3%. And of course, the winner of the day was the Russell 2000. The small caps are hopping back, baby. They were up 1.6%. Now, American Express and JP Morgan advanced more than 1% today, boosted by boosting the Dow Jones. Harley Davidson actually soared 8% after the company reported a surprise profit for Q4, while Imogen and Chegg climbed 7% and 16% after beating their quarterly earnings. 8 of the 11 S&P 500 sectors did close higher today, including 5 that gained at least 1%. The materials sector, up 1.6%, was the top performer, and the heavy-weighted information technology sector, up 1.3%. Those were the two next in line. The energy sector, on the other hand, declined 2% as oil prices fell below $90 a barrel amid speculation that the U.S. could allow Iran, of all places, to increase its oil exports. Now, regarding the 10-year interest rate, the yield came within 3 points of 2%. 3 points of the 2% level before settling at 1.9%. I think that's going to 2% relatively soon. It may cross over it. But the higher rates benefited, of course, financial sector. That was up 1.4%. But it didn't hurt growth stocks, which was very interesting. The Russell 3000 Growth Index rose 1.3%, besting the 0.7% gain in the Russell 3000 Value Index. And for what it's worth, the S&P 500 closed essentially at yesterday's high, 4521.55. And I'll look at that in closer detail here in just a second. But here's where we stand year to date. Dow Jones is down 2.4% year to date. S&P 500 down 5.1% year to date. The Russell 2000 is beating the Nasdaq now. It's only down 8.9% year to date, and Nasdaq is in fourth place, down 9.3% year to date. Okay, before we get too far into this live stream, smash that like button, share this video, and click the first link in the description to get our top 10 stocks lists and so much more. We've done the research so you don't have to. And if it's your first time here, my friend, thank you for joining me, and make sure to click that subscribe button so you never miss an episode. All right, thank you, my friends, for doing that. Now, I see here, I'm glad we talked about ENPH yesterday. I bought more shares and options today. They're going to print. Good job. Good job. I'm glad that helped. I am really glad. Let me pull ENPH up because it is going wild here in the after hours. It popped as much as 14% at one point. When I last checked on it, it's up to 15.1% in the after hours right now. So looking at the chart here, of course, the last green candle here to the right is where it closed. But of course, that's not where it's at. It's up to $166.38, which puts it right here. In the middle of that circle. So that's where it's going to open up tomorrow if it can hold on to this 15% gain. I love ENPH. I was a little nervous about earnings because I wasn't sure how supply chain was going to work out and weather, but they overcame all of their obstacles and had an awesome earnings report. I haven't had time, obviously, to listen into the call because that's taken place, but I did have a chance to look at the initial numbers for ENPH, and it looks as though ENPH came in. What were the numbers? Hold on one quick second. Get my notes here. Okay, ENPH. Q4 earnings, EPS of 73 cents, which beat by 14 cents, and revenue of $412.7 million, which was an incredible 55.8% year-over-year gain, and that did beat by 13.1 million. And then their guidance for Q1 22, the revenue for it is going to be within a range of 420 million to 440 million, which includes shipments of 110 to 120 megawatt hours of ENPH IQ batteries, which is incredible that they're able to do that. ENPH was able to meet the surge in customer demand while successfully navigating supply constraints. And of course, the logistics challenges that, of course, came up with weather. But yeah, ENPH did wonderful. I can't wait to dive into that earnings call to read a little bit about it. Yes, they crushed it. Absolutely, they did. One of my favorite companies. Absolutely. And quite frankly, them down here, could it be a bottom? I do find it interesting that this 15.14% gain in the after hours came right here, and I'll make it a different color so it's a little more obvious. But this yellow line that's running across like this, that's the 200-day moving average, and I'll change it to the same color as the line there. That's the 200-day moving average. So ENPH jumped up, it touched that, and it kind of stopped. It kind of acted as resistance there to keep it from going any higher. And that's sensible. That's reasonable. 15% gain. That's a really nice jump. So yeah, that's just interesting, though, that line came in there. The 50-day moving average is also there as well. It's coming down, just to make it a little more obvious. Oh, I didn't want to use that. Hold on one quick second. But the 50-day moving average is coming down like this. And I'll change the color. But this is what the 50-day moving average is looking like right now. Let's change it so it's the same color as the line. All right, so the 50-day and 200-day are kind of meeting there. You could call it the old death cross if you wanted to, but it's not quite a death cross yet because they haven't crossed. But it might not happen with this jump from ENPH, so that's looking pretty good. We also got Corsair Gaming. Their numbers came in also, so I should go ahead and pull that up. CRSR. And I've got a deep dive on Take-Two that I want to do about their earnings report, and I think it sheds a little bit of light about what's happening here with Corsair Gaming. So they're down 4% in the after hours, but they were up 5.8% during regular session. So, you know, they're still up about 1.7% total on the day. Although this 4% loss, it will get counted in tomorrow's percentage range. That's how it works. So their Q4 EPS came in at 35 cents, and that beat by 10 cents. And they had revenue of $510.6 million. And that was actually a decline by 8.2% year over year. But it did end up beating estimates by $13.66 million. So I find it interesting. We kind of looked at those numbers yesterday. We looked at what the company said. So I find that a little bit off from what we were kind of getting at. Now, the fiscal 22 guidance that they gave, net revenue will be in the range, and this is what we said yesterday, $1.9 to $2.1 billion. And of course, there's a $2 billion estimate right down the middle. And that's actually the number that we used yesterday when we were looking at Corsair. All right, there is one more quick little earnings that I want to go through right quick, and that's Peloton. I just want to go over real quick what they reported, and then I'll get into the deep dive on Take-Two. So PTON, they were up again, pretty massive during regular session. I haven't seen after hours. So yeah, look at that. I can take these off. They are a day old now. Up 25.2% during regular session and up 1.6% in the after hours. Still, though, it is down big from its high of $155 hit last year. And if we go down here and look, they're actually up 4.2% since the beginning of the year. I find that interesting. Okay, so you can see this yellow line coming across the top way up here above the candles. That's the 200-day moving average that ENPH is now up against. Peloton still has a ways to go to get that high, but they reported an EPS of a loss of $1.39, and that did miss by 47 cents on revenue of $1.14 billion, which was a 6% year over year gain, but that did miss estimates by $10 million. Now, Q2 ended with their what they call connected fitness subscriptions growing by $66 million, just like it did in Q2. And now they're up to 2.77 million, and their paid digital subscriptions grew by 38% to 862,000 subscriptions. The total membership grew to over 6.6 million now. And for fiscal year 22, their next quarter guidance, approximately 2.93 million ending connected fitness subscriptions and 950 million to $1 billion in total revenue. Now, gross profit margin should come in around should come in about 23%. And they did give an updated full fiscal year 22 guidance, approximately 3 million, what they are calling connected fitness subscriptions, and 3.7 billion to 3.8 billion dollars in total revenue, and of course the gross profit margin of about 28%. So that's the headline numbers there for Peloton. I cannot wait to read the the earnings call transcript for that. I do have my news service pulled up here to watch the feed, so if anything does come up, I'll talk about it. One thing of note, Lyft and Uber. Lyft is down 6.2% in the after hours off of a disappointing earnings report, and Uber, who has not posted earnings yet, They post tomorrow after the closing bell. They're down 2% in the after hours because of lifts miss. So we got that. Okay, sorry I missed that comment there. Should we buy 170 after it crosses the 50-day and 200-day? All right, let me pull ENPH back up right quick here. ENPH. Let me take a closer look here for this move. All right. If ENPH were to cross this 50-day, 200-day moving average, the next area of resistance for them is looking at to be 190. That would be the next area, maybe as low, yeah, 190, absolutely, because we can see it right here, and I'm going to draw a line. It's slightly over my head right here. This line right here is right about 190, $190 a share. That's where the next area of resistance would come in for ENPH if they were able to pop above that 50-day, 200-day moving average. So, yeah, some call options maybe at 170 wouldn't be too bad if they could cross above that. If we go to 170, we're looking right about at, let's see here. All right, so the 200-day is at $173. The 50-day moving average is $172. So 170 wouldn't be that bad. It might be able to hit 170 tomorrow, quite frankly, if it can carry this momentum. Right now, the RSI is only at a 51, and the money flow plus RSI is at a, let's see here, 63. So neither one are oversold yet. So there is room for it to move. So buying at 170 would just be shy of where the 50-day and 200-day moving averages are at this moment. All right. What's the next one? It's a great company. I have long a positions on it. Yep, I have longs on it too. Absolutely. And this whole way down this year, the month of January, more recently, I've been dollar cost averaging. I mean, I think that's the best you can do in a market that's going down is just dollar cost average, uh, and build your position because the market the market doesn't always go up, just like the market doesn't always go down. So yeah, it's a great company, and I'm really excited about their earnings. Um, all right, I hope I answered your questions there. If you do have any others, please feel free to leave them in the comments. Just making sure I. Okay, I missed that question. My apologies. So, with the earnings being good, and after this 15.14% pop in the after hours, what is a good entry point for ENPH? This is what I'll say about an entry point for ENPH. When I bring the chart in like this, you can see it is off from its highs. Even right now, it's at call it 170. It's a couple dollars away from 170, but using a round number like that, 170 is still well below the highs that ENPH has seen. So the best way that I think is instead of looking for entry points and just waiting for that specific entry point, unless you're trading, trading is completely different. But if you are a long-term investor and you're going to buy and hold for a couple years, 5 years, 10, whatever it may be, then the entry point becomes less important because you're going to end up dollar cost averaging over time. So buying now, if you're going to buy and hold for the long term, then the entry point doesn't necessarily matter as much. If you want to get the, I guess maybe a better entry point, then what I would do, and I use the RSI in combination with trends. So if the RSI is, on its lower level, like for end phase over the past couple of months, the lowest it's been on the RSI is around a 17. And the highest it's been is an 81, but that was back on November the 1st. So over the past month, it's been in the teens, 17, 18, 16 even, 14 even, but it's been going down. The stock price has been going down while the relative strength index has been kind of bottoming out. And if you use an RSI plus MSI, I'm sorry, MFI, if I said that wrong, which is the relative strength index plus the money flow index. And you can get that on TradingView. There's a link to a free account in the description. They will actually flash a buy signal or sell signal when those are at their absolute lowest points. So if we're looking here for end phase, since December the 13th, really through, let's call it, the last day here would be the 25th of January, you see these green boxes here at the bottom of the screen. Those are flashing it's time to buy because it's saying that the relative strength and the money flow that's going into the security is at its lowest level, the lowest level that it's been at. So using that as just one indicator to kind of guide you towards what's a good entry point, those were good entry points. Now, of course, the first time that it flashed that box was here when it kind of plateaued, when it fell from this high right here of $260. I'm sorry, $282. It's 52-week high, and it fell down to this flat area here where $190 became the resistance for in phase. It was flashing by, okay? But then it fell some more, and this entire way down, it's pretty much been flashing a buy signal all the way until, again, we get to the 25th of January, which wasn't quite the bottom of the stock price, but it was pretty low at $120. And the absolute lowest that it's gotten over the past month is $113. So you can use these technical indicators to help you find, okay, let me dollar cost average. Now looks like a good time to buy a couple shares. So you buy your few shares. And then a month goes by, you buy a few more. Just dollar cost averaging over the long term is the absolute best way to go about doing it when you've got high conviction on a stock like Enphase. That's exactly what I do when I'm buying long term. I use these different indicators. So when Enphase was falling here from this high, this 52-week high, and it reached this plateau, okay, now's a good time to add a little. It seemed to have pulled back, and if we measure how far down that was, if we go all the way to the top of the wick on the candle, down to the plateau area here, that was a 33% pullback in the stock's price. When you go to whatever store you go to, you buy a pair of jeans, would you rather pay full price or get the pair of jeans? They're exactly the same, but they're on sale for 33% off. I'd buy the jeans that are 33% off. Same thing applies with stocks. Now, trading, you have to have a different mindset and you do things differently. But investing over the long term, this is the mindset I'm talking about, and these are the kind of signals that I'd be looking for. Big discount like that, the relative strength is low, the money flow going into the stock is low. Those are all indicators. It's pulled down 33% and it's kind of hit a plateau here where it can't break above. Sure, that could signal that it's going lower because it doesn't have the momentum to go higher. But it's also a good place to take a breath. It's 33% cheaper. We can buy a few shares here, and then next month when we get our allotment for what we can invest in our budget, then next month we'll see where we're at, and if we're at a place to buy. If not, I'll wait. You can always set a limit order. So if ENPH gets to a particular dollar amount that you find to be a good entry point, then you could set that limit order, have the cash in there, the buying power in there to make the purchase, and boom, it's set. And then whenever ENPH reaches that dollar amount, then the order goes through without you having to constantly look at charts and think about, oh wow, what should I do and when should I do it? What's the market doing today? Just some things to think about. I definitely think ENPH at $125, 130, 140, 145. I think those are all excellent entry points for what ENPH is doing right now. Now, with ENPH up like it is right now, maybe this is just a nice little party breakout. And I'll use Google as an example because they had a blowout earnings last week. Okay. But this week, it looks really, really different. So earnings right here. And this is this could happen to ENPH. Earnings came out here on this first circle, right? And then it immediately ran up, broke 10% at one point. It broke my sell line right here at this next circle up here, right? Nice gap up, but it fell back down to earth. Because a lot of the people that are jumping in to buy ENPH that push it up that 15% are going to sell out of it because they're traders. That's where a lot of that 15% came from, not from your normal long-term investor. They weren't buying it, when it's going up 15%. Those are your short-term people jumping in to make a quick profit off of a good earnings and a good guidance. So what happened to Google here after their beautiful gap up, they filled in the gap. And this happens all the time in the stock market. Whenever you have a gap up, it is a very good chance, a very good probability that the gap will be filled in. And that's a common phrase. You can Google that. What happens to the stocks when type the phrase in to quote fill in the gap, and or stock market, and then in quotes fill in the gap, and you'll see that the majority of the time a stock gaps up like this, they will come back down to fill in that gap on their way back down. So I could see this with in phase here. So maybe a trading strategy could be put options, really. That would be shorting it. That's an option. Because this filling in the gap's a possibility, especially with this overall market environment that we're in. And if we get numbers that come out on later this week about inflation, and inflation is up higher than expected, then you can bet that the market is going to go down off of that news. It's what the market always does, right? When there's bad news, the market goes down. So I'm anticipating the market to be very wobbly and volatile, even though today was a great day overall for many different stocks. I think that filling in the gap for in phase is a possibility that we do have to consider. Okay, I see your question there. I'm bullish on CVS. What are your thoughts? CVS Health, I am bullish on too. Typed in the wrong one. CVS. All right, CVS Health, I think, is doing good. Their clinics that they're setting up, I think, is going to have a big impact. And of course, I think they're also going to have a big impact on of course, the vaccines being out there. Let me look up real quick what their earnings numbers are. TradingView does have them, but sometimes TradingView doesn't have all the information. So I like to confirm here. All right, so see, this is where something is different. The estimated EPS is $1.88 from one SP Capital IQ, but TradingView, where they pull their data from, is calling for EPS of $1.83. And revenue is different too. The terminal says revenue for CVS Health, $75.47 billion. TradingView says $75.65 billion for earnings coming up. So let's see how they have done here recently. Go to quarterly. All right, so a year ago, they brought in $1.30 a share. And last quarter, they brought in $1.97 a share. So it is doable. $1.88 is doable for earnings coming up. Let's see here. Revenue last quarter of $73.8 billion, and they need to do $75.4 billion. That's also doable. 72.6 the prior quarter. So they're up there, and they've got the numbers to do it. Debt's risen a little bit, but I expect that since they're adding clinics. And the stock has been moving pretty nicely over the past week and month. It's actually up 7.4% year to date. So it's been moving much better than, of course, the indices have. My one thing is that with the stock appreciating and the stock moving up, what do you think about good earnings already being priced in? That could be a possibility because the stock is up over the past week 4.29%. 4.29% over the last week, 6.3% over the last month, while the market is down S&P 500 down 5.0%. So that would be one thought that I would have for CVS. But overall, long term, I think it's a great company, and I think it has the potential to report good earnings. I mean, Look at this. This thing was stuck here in this sideways motion, going back all the way to May of last year, and then finally broke through in October. And since December the 3rd, I mean, it's been on a nice run, real nice run. Let's see here. Waiting for Tesla to come down to 825. It might do that, especially if we get bad inflation numbers this week. I think you can get Tesla lower with CPI data coming soon. Yep, absolutely. If we look at Tesla here, TSLA, and I don't want to miss anyone's comment, so if I do, I apologize. If we look here at Tesla, we can find some interesting things here. I know I got a ton of lines on here, which makes it hard to see. This 885, I've had this line marked out for a while, because if we go back here to this big run up, right in the middle of your screen, the peak right here, that's at 885. So this line right here is 885 for Tesla, right? And that was back last year, January, February 2021, where everything was just running hot. And then we fast forward to where we are today, and 885 does not seem like it's that far off. 885 is this line right here, and I'll put a line here. 885 is right here. So you can see that Tesla back here on January the 27th, especially the 28th, that was the lowest it's been in a while. We're well below $885. As a matter of fact, on this particular wick here on the 28th, it got as low as $792 a share. So, and this is where, remember when I was talking about the RSI and the money flow index on January 24th, when Tesla broke its support for the first time in months and dipped down to $851. Well, the RSI and the MFI flashed a buy signal at that moment. So you could have picked up Tesla at 851 at the lowest. And that still wasn't the bottom. That was 1, 2, 3, 4 days before the actual bottom. And if we go back to the last time a buy signal was triggered, that was right here on December the 20th, which was the bottom of this symmetrical triangle right here in the middle of your screen before it went on its big rally all the way up to $1,208. So for me, this system is an excellent source to help guide when you should get in, when are good entry points. If you're trading, it's really helpful because it can tell you quite a bit, especially for getting in and out of short positions or short-term positions. But it's just one indicator out of many different indicators that you can use to help you out. But I think Tesla, I think you'll be able to get it at 885 again relatively soon, especially with that CPI data. Good call there. Okay, let's see here. Oh, Take-Two. I did want to talk about Take-Two and Harley Davidson and do a deep dive on both of them. So if you have any more questions, just go ahead and ask them. It's fine. I can stop whenever and go over whatever you want to. So we're good. All right, so Take-Two ticker symbol is TTWO. And again, this should also shed some light on Corsair Gaming. Yeah, here's what's going on. All right. So they came out with their earnings report, right? Let me put a vertical here to mark where that earnings were. And you can see they had a gap up, right? It ran, let's see, what did it actually do? All right. So it ran up to, where's the top of that wick? Right there. It ran up 2%, not much. And then it fell into the red by another 2.8%, but it finally settled down 1.6% on the day. So it did have some wild swings, but it was down today. And I guess I could say that Take-Two shares, they were down slightly following the company's, I'd have to say, downbeat Q4 guidance. That's really it. The pandemic's positive effects on gaming, they're beginning to cool off right now. And this is now the second consecutive quarter in which the video game publisher, which owns major franchises like Grand Theft Auto, NBA 2000, and what's that other one? Red Dead Redemption? Is that what it's called? I think that's what it's called. But they guided quarterly net bookings significantly lower and below estimates. Take-Two's CEO even stated during the company's Q3 earnings call that Take-Two is now seeing, quote, normalized demand. What is that supposed to mean? Normalized demand. Investors may need to start, I guess, quelling their expectations moving forward on Take-Two. And could this be happening at Corsair Gaming? It's a question. I think the main takeaway from Take-Two's Q4 net bookings guidance of $808 to $858 million, that is not so much that it is below estimates, but that it translates to just 6.3% growth at the midpoint of guidance, which pales in comparison to the outlook of video game publishing powerhouse Electronic Arts, or EA. Last week, EA guided revenues slightly below estimates. However, EA still expects solid growth of 18% year over year next quarter. That's much better than Take-Two, which is very stark contrast compared to Take-Two. Now, EA is also lapping a more favorable quarter. Its revenues jumped 18.8% a year ago, whereas Take-Two is lapping a much smaller comparison at 7.6% increase. Now, despite its light guidance and its comments regarding demand normalization, I don't get why they say that, but Take-Two still posted strong Q3 numbers, followed up with upcoming catalysts that should provide shares with further upside. For one, daily active users, or DAUs as they call them, of the NBA 2000, well, it rose 10% year over year to 1.9 million. This franchise remains a pivotal component of Take-Two's growth, particularly given its popularity overseas. For example here, it remained the #1 online PC sports game in China with over 55 million registered users. and that's up from 51 million a year ago. While EA in its FIFA, is it FIFA? Their franchise, soccer, right? Um, which is one of its primary revenue drivers, given it's definitely has a global appeal. Take-Two competes on the sports gaming front with its own NBA 2000. Two different sports, but still. Take-Two's Grand Theft Auto franchise continued to be a standout. For example, the remastered version of 3 older Grand Theft Auto titles helped drive Take-Two's 6.4% net bookings growth year over year in Q3. Furthermore, the company's Grand Theft Auto 5 title uh, continued to exhibit strong sales growth despite being almost 9 years old. I can't believe how old that game is now. Old at this point, as monthly online engagement in 2021, it matched the record high levels of 2020. I believe Take-Two's Grand Theft Auto series is its key competitive advantage over peers like EA or Activision Blizzard, which is, by the way, being purchased by Microsoft for over $68 billion. For example, last week, investors pushed Take-Two shares higher on reports that development for its next entry in the series is well underway. As such, even with Take-Two's light Q4 guidance, investors are looking ahead to 2023 when it is rumored to be the next iteration of Grand Theft Auto and it will launch in 2023. That will be a big catalyst. But is there a real big catalyst for Take-Two now until 2023 when Grand Theft Auto launches? The next version of Grand Theft Auto? I'm not sure there is. Lastly, although investors had a cold reaction to Take-Two's plans to purchase mobile game giant Zynga, had about 64% premium, I think the acquisition has substantial benefits. Through the deal, Take-Two would vastly expand its mobile gaming presence, which is essentially a must-have given how increasingly mobile consumers have become. Take-Two also expects at least $50 million in annual net bookings over time from Zynga, making the premium price tag more sensible, right? Overall, mild or soft, however you want to frame it, Q4 guidance is somewhat overshadowing Q3's solid numbers. Also, aside from seasonal updates to sport titles, I mentioned this just a moment ago, Take-Two does not have any huge releases slated for the remainder of 2022. So, again, normalized demand trends, they are weighing especially heavy on the stock, as there's not really much to expect to reignite gamer enthusiasm in the near term for Take-Two. Nevertheless, many of Take-Two's franchises are too critical to its success to be rushed through development. I understand that. That would risk a huge, disappointing release. And such hastiness has plagued the video game industry before, as with Battlefield 2042 from EA and the remastered Grand Theft Auto titles. It can discourage loyal fans indefinitely. So, Take-Two for the rest of the year doesn't really have any big catalysts, and that could weigh heavily on the share price of the stock. Now, Once 2023 comes around and we start hearing news about Grand Theft Auto and their next iteration being launched, that will be a big, huge catalyst for Take-Two. All right. Let me know what you think about Take-Two in the description. And if you think that now they're done for the year, right? No other big catalysts to mention for them. Okay. Moving off of that, let's go to Harley Davidson because there's some wild stuff happening over there. Ticker symbol is HOG, as their big bikes are considered. I know the market is punishing fintech and growth stocks, but I still like Affirm and Net, especially at these prices. What are your thoughts? Okay, before I get into HOG, let's talk about first Affirm. I personally like Affirm as well. I think if Affirm can really get a connection with retailers, where when you're checking out, Affirm is as easy as tapping a button to use it when you're buying, say furniture, for example. You want to buy a new couch, right? Well, if they can get in, with Lazy Boy, for example, and work out an agreement, and then the consumer goes into Lazy Boy and, well, ma'am or sir, we can spread this payment out for you for 6 months. That would make it a little bit more easy to purchase. And of course, that's zero interest on that. Oh, and by the way, did you know that as long as you make those payments on time, that helps to boost your credit score? If a firm could do that, that would be game over. Because who would not choose that? You go into a furniture store, you buy a couch, you press a button, you sign your name, and now all of a sudden you're making 6 easy, balanced payments over 6 months to buy that couch, and you can take that couch home right now. And at the end of that, when the transaction is finally wrapped up after 6 months, then a firm reports to the credit card bureau to help boost your credit score, because that was a credit-worthy exchange that took place. That would be incredible. I think people would take advantage of it, not just because it's an easy way to spread your payments out. It keeps a little more cash in your pocket right now that you can, maybe you can use that to invest in, right? And then it can also build your credit. That is just wow. That's just wow. Now, if we look at Affirm, it's down to $65. It was up 3.5% today, 0.2% in after hours. But look at this. If we go back here, just after they became public, their earnings on May 10th right here, and then we put a vertical there. This low right here was right around $47.12, $47.12. And then we come over here just before earnings, and 47.12, and then this low right here was 48.17. I think we may we just may be starting to see a floor or what's called a base being built for a firm's stock, where it's an area that even on bad days, this thing can get support at that area. So I'm going to put a line here at 46, which is just below that the 47.12 and the 48.17. That's like the area of support for this thing. And when it fell most recently, again, January 28th was a very important day in the market because a lot of stocks individually and the overall S&P index for sure, they bottomed on January 28th. So I'm wondering if January 28th was the bottom or if we're going to see another leg lower or what. And I think it's a real possibility that we do see it go down a little lower. But this area here at 146 is very attractive to me. I like it a lot. And for a firm, it had its new partnerships, like with Amazon. And we are just now getting over, of course, the holiday season. That's the quarter they're going to be reporting on. I'm really, really curious because if we go back and look at their earnings that they reported here, we have to go to February 1, right? And it was their very first earnings report. So they probably didn't get everything exactly right how they wanted it. But they came in at a loss of 37 cents, which beat by 54%. And they came in with $204 million in revenue, right? And this again, this report came in right after the holiday season. So it should have been a highlight, especially over the next quarter. But the next quarter, they had a loss of $1.05. So they lost more money. And they lost by over 244%. It was a tough one. And then they had revenue. Well, that went up by 230 million. So you had an extra 30 million in revenue. Okay. So for right now, let me pop over here to the terminal and put in see what their EPS estimate is. And it's a loss of 22 cents. So here, a loss of 37. We're looking at a loss of 32. We had revenue of 204. We have estimated revenue of $333 coming up. All right, last earnings, they did 269 million, and we need 333 million. They lost again $1.13, and the estimate is a loss of only 22 cents. Let's look at this one real quick. This was a loss of 38 cents, so that's getting a little better. But still, 2 quarters here where the losses were over $1 per share. So with these earnings, 22 cents, they got to beat. I think they can, but then again, it is a new company. It is sorting things out, but I do like it at $46, $45, $48 a share. I like it down there. Remember, this is a bit of a new style of company, right? I mean, we've had buy now, pay later companies before, like a firm. I mean, it was called layaway back then, and it was done a little differently, but, I mean, we had it when I was a kid, but, so it's a little bit different take, uh, on layaway, of course, so it still needs to prove itself. I think that's what has a lot of investors just sitting on the sidelines, watching a firm, seeing what it can do, reading the earnings reports. It needs to prove itself. And like I said at the beginning when I first started talking about a firm, if it could do that for the consumer and prove its business model for the investors, then I think it is a wonderful company to invest in. It's definitely one of the leaders in this space. I mean, you got PayPal and Block, working on buy now, pay later options. But yeah, I like the company. I'm just not sure how well it can do yet. Um, I think earnings could very easily go either way, but I do like it around 45, 46, 48. I like it at that level for adding shares on. Your next one, ticker symbol NET, which is Cloudflare. Um, any company that offers any type of security is going to be needed. Valuations did get stretched. It is down 16.3% year to date, but any type of company like Cloudflare that can provide security, because our world is going to continue expanding into the digital space, and our information is going to need to be protected at all costs. Companies like Cloudflare are ones that can do it. Now, it's at $109 a share right now. And if I'm looking here for any type of support areas, I'm definitely going lower than where it is right now. And I'm looking at right around uh, $87 down to $65. It did dip in there for a couple days, January 28th, January 27th, January 26th. We're all in this area. It could have a good earnings and it could jump, but I do believe it's going to come back down to this area. I don't think we're out of the woods yet in this market. I really don't think so. I don't think the pullbacks we've seen are substantial or not. Uh, I don't think they've been. I think there's more. I mean, this was a 64%, so it was totally cut in half and then some. Uh, Between what is this? November 19th through January 28th, it was cut in half and then some. 64% was taken out. But it's just that I don't even think the best macro environment scientists could even predict what's going to happen next. So I'm just looking to dollar cost average on great companies, companies that are going to save my life, companies that are going to make my life easier, companies that I have high conviction in, companies, like I said yesterday when talking about it, and I'll pull Datadog up here too. Um, like I said yesterday when I opened up the live stream, one of the best investing strategies you can have is invest in things that you own and you love. If you've got an iPhone and you love it, buy Apple. If you're wearing Nikes and you love the shoes and you think they're good quality, buy Nike stock. And this is for like new investors or long-term investors can even use this, but it's really good for new investors looking to invest for the long term. If you're using, an Android phone or an Android Chromebook or something, buy Alphabet. Uh, whether it's a product or whether it's a service, if you own it and you love it, then buy that stock and hold it for 10 years. You will come out ahead. Good companies are good companies. It's just a real simple investing idea that it can be used for anyone. Even pros use it. They might not want to admit it. uh, I definitely started that way. Definitely did. Okay, Datadog, something wrong in the after hours. I've got it pulled up here. Datadog is down because, all right, NEWR. So New Relic. All right, New Relic had bad earnings right here. They missed EPS by a penny, 5.6%. They beat on revenue by 1.6%. I don't know what kind of guidance they had. Let's see here. Let's see here. Q3 loss, revenue rises. Yep, we just talked about that. Let's see here. Moving forward, New Relic said it anticipates a fiscal Q4 non-GAAP loss of 19 cents per share to 22 cents per share, and it just lost 18 cents per share. So it looks like it's going to get worse next quarter. The company also expects fiscal Q4 revenue to be in the range of $204 to $206 million. Analysts polled by Capital IQ are expecting adjusted Q4 losses of 4 cents on revenue of $204 million. So revenue is coming in a little bit higher on estimates for the next quarter. And EPS is coming in at a bigger loss than this past quarter. And New Relic, since they had bad earnings, they are pulling down Splunk and they're pulling down Datadog. New Relic is down 22.5% in after hours, and that is pulling down other companies that do similar things. Just like ENPH, who posted good earnings, lifted up other solar tech companies like SunPower. Their stock went up in the after hours just because ENPH posted good numbers. So that's what's happening right now with Datadog, also with Splunk. They're also DT. Who's DT? I don't remember DT. Dynatrace. They're also lower because of New Relic's earnings. So there's a few companies getting hit there because of New Relic. So I hope that answers your question about Datadog. That's what's happening. It's just going down in sympathy. No, is that right? sympathy? No. Anyways, the New Relic is pulling them down. That's the quick answer, and it's off of bad earnings, and weak guidance. So then that means there's a possibility that Datadog could potentially then report similar earnings. It's possible, but not exact. All right. Yeah, I did want to talk about Harley Davidson. Just looking at any other news here. So that seems to be it on Datadog. All right. All right. So thank you guys for all the questions. I greatly appreciate them. I'll talk about Harley Davidson, and then if you have any other questions, feel free to get into it. Ask me anything you want. We can do the research here while you're watching and hopefully be able to connect some dots. All right. HOG. Oh, wrong screen. HOG. That is Harley Davidson's ticker symbol, HOG. And you can see a nice gap up there. But again, whenever you have that gap up scenario, you can usually expect that gap to be filled back in when it's coming back down. So it's always fun to see it gap up like that. And sometimes it does stay elevated. I mean, I can show you right here where Harley Davidson has gapped up and did not fill in the gap. So if we go back here to earnings back in April of 21, they gapped up before and after earnings came out. And then, of course, as they were coming back down, this whole triangle here, they were filling in the gap. But if we go back here to earnings on October 2020, there was a gap up here, and that gap never did get filled back in. Never. Not even to this day has it been filled back in. So October 2020 all the way to February 22, that gap remains open. So two gaps here, they got filled in this triangle. And then the gap back here, I guess it might be over my head. You can't see it. There's a little gap right here where I'm waving the cursor around. Here, let me just put a circle in that hole. But this gap right here never did get filled back in. So that's the saying there, when a stock gaps up like it did here, the gap will always get filled back in. Sometimes it doesn't. Sometimes it does work out that the gap doesn't get filled back in, but most of the time it most certainly does. All right, so here's Harley Davidson. Big explosive pop here, up 15.5% in regular session, up 0.6% in after hours. It's way up here. There is no wick on the top of this candle up here for Harley Davidson. So, all right. We'll get into Harley Davidson, and then we'll wrap up the video unless you got something else that you want to talk about. But for Harley Davidson, ticker symbol HOG, I would say they are definitely making some noise today after the motorcycle maker posted an impressive beat and raise Q4 report that was fueled by a robust recovery in its critical North American market. And just a year ago, when revenue plunged 32% in Q4 2020, this comeback seemed impossible as its bikes continued to fall out of favor. The buzz that it was, or that its brand just was not recognizing, or wasn't recognized by, or wasn't resonating with the younger generations. That buzz just grew and grew and grew, leading many to believe that Harley Davidson's best days were far behind in its rearview mirror. Amid that discord, Harley Davidson launched a 5-year strategic plan dubbed Hardwire in February of last year. Among the many objectives of that initiative, two really stand out today in the wake of Harley Davidson's strong results. Specifically, the company's mission to target long term profitable growth and to invest in high priced touring and large cruiser motorcycles played a huge role in Harley Davidson's vastly improved performance. This maneuver to focus on high margin cruisers and touring models rekindled demand with Harley Davidson's older customers, especially as interest in traveling has grown through the pandemic. The positive impact from Harley Davidson's turnaround's efforts can totally be seen across a number of metrics. For instance, despite contending with supply chain issues, retail sales in the US increased by nearly 10% to 18,855 units. Leading the way was the Grand American Touring Motorcycle, with global unit sales up 67% year over year. Additionally, favorable product mix helped Harley Davidson to mitigate surging steel prices as HDMC motorcycles and related products operating margin that improved to a negative 12.5% from a negative 37% a year ago. Pockets of weakness still exist, however, especially in Harley Davidson's international markets. While progress has been made in EMEA, retail sales were still down by 7% year over year to 6,521 units. Some of the softness in Harley Davidson overseas markets can be explained by its deliberate decision to exit certain unprofitable markets. Looking ahead, though, the company will continue to face challenges regarding logistics and supply chain. In fact, Harley Davidson CEO commented that headwinds have intensified recently. That news, though, doesn't come as a surprise to investors. What is more surprising is that sharp rebound in sales, which Harley Davidson expects to continue in fiscal year 22, with HDMC revenue forecast to grow 5 to 10%. Another event to look forward to is Harley Davidson's spinoff of its electric Livewire, which is an electric vehicle. That's right, an electric motorcycle, an EV motorcycle. Now, that spinoff will happen later in the first half of 22. I'm very excited about it, by the way. The transaction will net nearly $550 million in proceeds, and it will allow Harley Davidson to still participate in the red hot EV market since it's retaining a 72% stake in Livewire. Overall, Harley Davidson's future hasn't looked this bright for many years, explaining why the stock is roaring today. But what do you think about Harley Davidson? And more specifically, what I'm most excited about, Livewire, their electric motorcycle. What do you think about Harley Davidson and its turnaround and its code name, Hardwire, to fix their problems, turn the company around, refocus, rebrand Livewire as an electric vehicle that it is, the electric motorcycle for the younger generation. I think it's incredible. I'm really excited and pumped about it. But let me know what you think. All right. Real quick, before we wrap this up, excuse me. I want to talk about what catalyst we have for tomorrow, Wednesday, February 9th. Now, the HSR, regulatory review period on the AMD and Xilinx deal ends, which could clear a path for the highly anticipated $35 billion merger to settle within days. Also, True Simple, ticker symbol TSP, they report earnings tomorrow. Now, just like Aurora Innovation, who focuses on automation for electric vehicles or big rigs or any other car that wants to have autonomy, right? True Simple is a pure play on that, just like Aurora Innovation. Now, True Simple, they do post earnings tomorrow with an estimated EPS at a loss of 54 cents with revenue of $2.16 billion. And it's expected to see a 20% move after it reports earnings based on options trading. Also, CVS Health, CVS, we talked about this earlier in the show. It posts earnings tomorrow with an EPS of $1.83 a share with revenue of $75.65 billion. Now, the only concern I have on CVS, they've been doing so good with their share price appreciation that could share prices be priced in? Could the price of earnings be priced in? That's my only concern. I do think the company is doing great. I do think the company has got a good shot, especially with the physicians and being able to, literally take patients and, prescribe them for whatever their problems are to the pharmacy that's right in the same building. It's a great concept. A lot of independent chains do this. Here in our area, Patient at First is one. They're like mini little hospital or satellite hospital, but they've got their own pharmacy for some small stuff. Like if you have the cold or flu or strep throat or something like that. So CVS has got a real plan here to navigate that. But again, that's CVS. Just talking about there. All right. Also, DraftKings reports as well. Ticker symbol is DKNG. They report earnings tomorrow. Now, they have an estimated EPS at a loss of 81 cents a share with revenue of $445.48 million. Now, this is one that's gotten beat up. You can see it's $22 a share right now. It is off from that $74 high. But again, did we hit a bottom here on January 28th? Maybe. January 24th, in that time frame. It's possible. I don't think so. I think things can go lower, unfortunately. Now, DraftKings here, unfortunately, too, has got a long history here of missing its earnings report. So, why would it do anything different? Huh? I mean, we've got to go all the way back here to March of 2020 to find an earnings beat. Look at all these red boxes here. Those are all earnings misses. So, is that what we can expect? Maybe. Also, Pepsi reports earnings tomorrow. They've got an estimated EPS, ticker symbol, PEP for PepsiCo, Estimated EPS of $1.52 a share with revenue of $24.24 billion. And then we have one of the ones that I'm watching closely, and that's Disney. DIS is the ticker symbol for Disney. I'm definitely watching this one, watching user growth in Disney Plus, because this stock has been on a downtrend since breaking $200, $203 on March the 10th, 2021. It has just been trending down. I've got this oval box here. I'm thinking that, can it stay in this box? That's really what I want it to do. I don't want it to go much lower. But of course, we got a couple things to talk about with Disney's earnings. Subscriber growth. Are they growing, or have they peaked? Are they slowing down? Are they losing subscribers? Just look at what happened to Netflix, okay? And Disney is just one part of Netflix, so don't worry too much. Well, there's a lot of focus on the streaming Disney Plus service. Don't forget that there was a lot of content added to Disney Plus, right? There were movies. Shang-Chi was out. Spider-Man No Way Home was out. Big movies were released. We also have big content on Disney Plus, if I didn't mention that already. And then parks. They were able to increase capacity. So do all of these things add up to a beat on their earnings? And then what do their guidance look like? I can imagine with all the content they have coming out, their guidance, at least in that department, probably looks pretty darn good. But they're also spending money to produce that content. So we have to see what that ratio is, right? All right, they do have an estimated EPS of 63 cents a share with revenue of $20.96 billion. And then we've got Uber posting earnings tomorrow as well. We know Lyft didn't do good, and Lyft was down over 6% in the after hours. Uber, UBER, Uber Technologies, they were down a couple percent, 1.4 now, so not as bad. It's come back a little bit. They post tomorrow. They've got an estimated EPS at a loss of 29 cents a share on revenue of $5.36 billion. Now, we also have Mattel, Matt, posting tomorrow. Now, Hasbro, they posted earnings and did not do so hot because Mattel took a licensing deal away from Hasbro that Disney was offering for, I think, Disney princesses, Disney's Frozen line, and there was another licensing aspect to that deal that Mattel got away from Hasbro. So interesting to see what they might be able to pull off. But they do have an estimated EPS of 33 cents a share on revenue of $1.16 billion. All right, let's check in on Bitcoin and then we'll wrap this up unless you've got some questions. BTC USD on TradingView. There is a link in the description for a free account to TradingView. If you do happen to sign up for a paid account, you do get $30 right away. All right, so Bitcoin, and this is really, really good. Bitcoin is now back above its trend line, its lowest level trend line. This is really, really good news for Bitcoin that it's back above this area. We had the death cross where this purple circle is right here in the middle of the screen there. And then we had the final sell-off We reached our bottom here January 22nd, January 23rd, which then it turned around, and now it's been climbing, and it is finally back above its 50-day moving average and its trend line. Two areas that should have been resistance that are now should now be acting as support. So that is very important. It's at 44,148 right now. I'm very happy to see it back above that 50-day moving average, which is incredibly important, and its trend line. Both things very important. Okay, that is Bitcoin for us today. And we'll go ahead and wrap it up here. So if you did find this video to be helpful, informative, actionable, then there's three things that you can do, ladies and gentlemen. Number one, smash that like button. Number two, take the URL and share it wherever you can. And number three is to click the first link in the description to get our top 10 stocks list and so much more. We've done the research so you don't have to. Well, that wraps it up, ladies and gentlemen. If you are new around here, though, please do consider hitting that subscribe button so you never miss a video. All right. Thank you so very much for joining me, and I'll see you in the next video.